Corporate governance refers to the system by which companies are directed, controlled, and held accountable in the interests of shareholders and wider stakeholders. It provides the framework through which corporate objectives are established, risks are managed, performance is monitored, and management is held accountable for its stewardship of corporate resources. The primary objective of corporate governance is to promote long-term sustainable value creation while ensuring transparency, accountability, integrity, and ethical business conduct. Strong governance structures reduce agency conflicts between shareholders and management, improve investor confidence, strengthen financial reporting reliability, and enhance the effectiveness of both internal and external audit functions. High-profile corporate failures such as Enron and Carillion demonstrated that weak governance arrangements can result in significant financial losses, fraud, reputational damage, and loss of public confidence, highlighting the critical importance of robust governance systems. International corporate governance frameworks provide principles that support effective governance across different jurisdictions. The OECD Principles of Corporate Governance emphasize 6 key areas: an effective governance framework, shareholder rights, the role of institutional investors, stakeholder participation, disclosure and transparency, and board responsibilities. Many national governance codes, including the UK Corporate Governance Code, reflect these principles through a flexible comply or explain approach rather than rigid legal rules. The board is expected to establish corporate purpose, values, and strategy, promote an appropriate ethical culture, maintain effective internal controls, manage principal risks, engage constructively with stakeholders, and ensure transparent reporting of governance practices. These principles are particularly relevant to auditors because governance quality directly influences audit risk, internal control effectiveness, and financial reporting reliability. Directors bear primary responsibility for establishing and maintaining effective corporate governance arrangements. They are responsible for preparing fair and balanced financial statements, establishing robust internal control systems, identifying and managing business risks, and ensuring compliance with legal and regulatory requirements. The board should maintain an appropriate balance between executive and non-executive directors, separate the roles of chair and chief executive officer to prevent excessive concentration of power, and establish transparent policies governing appointments, remuneration, succession planning, and performance evaluation. Directors must also ensure that risk management frameworks are integrated into strategic decision-making and that internal controls operate effectively throughout the organization to safeguard assets, ensure reliable reporting, and support operational efficiency. External auditors have important reporting responsibilities within the corporate governance framework, although they are not responsible for establishing governance arrangements themselves. Auditors evaluate the effectiveness of governance-related controls insofar as they affect financial reporting and audit risk, communicate significant control deficiencies to those charged with governance, and maintain ongoing dialogue with the audit committee regarding audit findings and independence matters. In some jurisdictions, auditors are also required to report by exception where governance disclosures or directors' statements appear materially inconsistent with evidence obtained during the audit or where governance reporting fails to address matters communicated during the audit process. Consequently, strong governance facilitates more efficient audits by reducing control risk and improving the quality of financial reporting. Evaluation of corporate governance deficiencies forms an important element of audit examinations. Common weaknesses include excessive concentration of power where one individual serves as both chair and chief executive, insufficient numbers of independent non-executive directors, lack of independent board committees, ineffective performance evaluation, inadequate financial expertise on the audit committee, weak succession planning, or absence of internal audit. Such deficiencies may impair board independence, reduce accountability, weaken oversight of management, and increase the risk of financial misstatement or fraud. Appropriate recommendations include appointing independent non-executive directors, separating leadership roles, establishing nomination and remuneration committees, introducing annual board evaluations, strengthening risk management systems, improving governance disclosures, and enhancing board diversity and expertise to support objective decision-making. The Audit Committee is one of the most significant governance mechanisms supporting both directors and auditors. Best practice recommends that it consists entirely of independent non-executive directors, with at least one member possessing recent and relevant financial experience and sufficient sector knowledge. Its principal responsibilities include monitoring the integrity of financial statements, reviewing significant accounting judgments, overseeing internal financial controls and risk management systems, monitoring the effectiveness of internal audit, recommending the appointment and remuneration of external auditors, safeguarding auditor independence, and reviewing policies regarding non-audit services. The Audit Committee also acts as an effective communication channel between management, internal auditors, external auditors, and the board, thereby enhancing governance oversight and financial reporting quality. Despite its benefits, the Audit Committee has certain limitations. Recruiting suitably qualified independent directors with sufficient financial expertise and available time may be difficult and costly. The committee depends heavily upon information supplied by management and internal auditors and cannot substitute for executive management responsibilities. Furthermore, ineffective committee members or inadequate meeting frequency may reduce its effectiveness. Nevertheless, a well-functioning audit committee significantly strengthens corporate governance by improving financial statement credibility, enhancing auditor independence, promoting stronger internal controls, and increasing investor confidence in corporate reporting. Internal control and risk management are integral components of effective corporate governance because they enable organizations to identify, assess, mitigate, and monitor risks that may threaten strategic objectives or financial reporting reliability. The board must establish an effective internal control framework supported by appropriate risk management policies, while continuously assessing the principal risks facing the organization and determining acceptable risk appetite. Strong internal controls protect assets, prevent fraud, ensure regulatory compliance, improve operational efficiency, and support reliable financial reporting. From an audit perspective, effective governance, risk management, and internal control systems reduce control risk and enhance audit efficiency while contributing to sustainable corporate success and stakeholder confidence.